Hello, everyone, and welcome to Strike Up Connects Women, Wealth, and Planning for Your Business, presented by the Scotiabank Women Initiative. I'm Heather Cannings, the program lead for Strike Up Canada. Thank you so much for joining us today. We'd like to begin by acknowledging that we are gathered virtually from many places. I am hosting from Cobourg, Ontario. We respectfully acknowledge that we are located in the traditional and treaty territory of the Mississauga and Chippewa Nations, collectively known as the Williams Treaties First Nations. We are grateful for the opportunity to live, work, and gather on these lands, and to learn from Indigenous peoples whose knowledge and presence continues to shape this land. So just a quick note before we begin, this webinar will be recorded, and you will all receive a link to rewatch along with additional resources to help you plan for the future. So after the presentation, we will have a live Q&A with Jill. So feel free to submit any of your questions in the chat throughout the session as they come up, and we will do our best to address as many as possible. So for those of you who are not aware, Strike Up Connects is our free webinar series that connects women entrepreneurs with practical education and tools throughout the year. Watch past sessions at strikeup.ca/connects. So today's session is brought to you with the support of the Scotia Bank Women Initiative, an enterprise-wide program designed to increase economic and professional opportunities for women clients through equitable access to financial solutions, education, and inclusive advisory services and mentorship. You can learn more at scotiabankwomeninitiative.com. So now I am pleased to welcome Jill Knowles, CFP, CIM, CFDS, and Senior Wealth Advisor and Portfolio Manager at Scotia Wealth Management. So Jill brings more than 2 decades of experience in investment and retirement planning, estate planning, and insurance needs analysis, with a particular focus on empowering women through the planning process. Jill, thank you so much for being here today, and happy to pass the floor now over to you.
Thanks so much, Heather, and good afternoon, everyone. I'm looking forward to speaking with you all today, and I'll give you a bit of background about myself. So Heather mentioned the Scotiabank Women Initiative. There's many different business lines within Scotiabank. So I am with the wealth management line, and it's there that we do a lot of the financial planning as well as investment management. Over the past I've been doing this for 20 years, but I would say the last probably 5 to 10 years have had a real focus specifically with women, and also specifically with business owners. So I get asked this. There's so many questions that I get asked when it comes to from business owners in terms of, when should I incorporate? I am incorporated. How do I get money in my corporation? And then the ultimate question as you're building wealth within your corporation that comes up is usually, okay, now how do I get it out of my corporation? How do I start getting this out personally? How do I start planning for the future? And that's what we're going to focus on today. So again, I've been doing this for 20 years. My passion is financial planning. I always start with financial planning. The money management side of things really comes out of the financial plan, because you want to know what the purpose of any money you're saving, what the purpose of that is, when you need that in your lifetime. And, we figure all that out through the financial plan so that we can invest different types of assets, or if they're owned personally versus corporately, or they're for your children, that we can invest them in the appropriate way so that it makes sense for the goal that they each of those buckets have. When we talk about companies, there are a few. So we sent out a questionnaire ahead of time, and so you answered whether or not your corporation or your company was incorporated or not incorporated. And so there was about 2/3 who responded that they were incorporated, and about 1/3 not. So I'll try and be general and sort of give you both options, because there are 2 different answers if you're incorporated versus a sole proprietor. So I'll try and differentiate those where I can. Also, please keep in mind that I am not an accountant, so I will be talking about some tax strategies. But cannot legally provide tax advice. So these are things that you can take back to your accountant to actually, talk about and look at implementation. I'm also based in Ontario, so I will sort of keep it Ontario based. But again, please know that we're from some different provinces on here, and there are some minor differences in taxes province to province. So again, if you have some of the ideas that you want to talk to your accountant about after today's session, just say, here's what I heard, but she was based in Ontario. Like, I need to know how this applies to me in Alberta. So yeah, just giving you a heads up on that. The other thing is that some of the tax strategies we're going to talk about can be very complex. And I just want you to know that you do not need to know all of these. Your accountant needs to know them. You just need to know that strategies exist and how certain strategies might apply to you. You don't need to know the ins and outs and all the different tax mumbo jumble. And it's just leave that part to your accountant. I just want you to be aware that certain strategies exist. And that's why I'm going to keep it fairly high level. But we can get into more details, and I imagine we probably will during the Q&A session. So to start, I think a lot of it is at the beginning, we're looking about, okay, how do we save in our business? Our business is making money. We're now saving in our business, and we're trying to build wealth within our business. Then we look at, okay, what if we want to sell that business either now or down the road? Or let's say we sell the operating business, but we want to keep that money we've maybe accumulated or saved over our lifetime in our business. And so you may have heard the term from your accountant or other business owners. A lot of times there's an operating company, or OpCo for short, and then a holding company. And so a lot of times the business owners will keep their day-to-day operations in the operating company, and if the business is successful and there is the savings there, and there's sort of a bulk of savings, they may move that up to a holding company, and just so that it's not sort of commingled with your day-to-day operations. So down the line, when you eventually sell your business, you may sell the operating company, but the holdco can keep that savings well into your retirement. That can be a source of retirement assets or income for you. And we're going to talk a little bit about what does that look like to start drawing from a holding company. So Heather, I'll get you to switch to the next slide, because we're going to look at two topics. This is the sort of, if you sell your business, how do we deal with that? And then I'm going to talk about the estate planning side of it, because you will still have probably some assets from your business that you have throughout retirement. And then what happens if you pass away? Or even if you lived a life expectancy, you may never spend the money that you've earned during the life of your business. You may never spend that during your lifetime. And so we see this a lot, where there is going to be money going to the next generation. And as we know, in Canada, we pay a lot of tax on everything. So how can we try and do some planning ahead of time to minimize the tax burden that we likely will see, and it becomes more of a burden in the year of death? So if you can do some planning up front, there's ways to mitigate the taxes. So I'll start first on, okay, what if you want to sell your business? So if you've created some wealth in your business, and let's talk first about maybe sole proprietors. So at this point, I'm talking about for people who are not incorporated. A lot of times there, most of the money earned in the business each year is going to be flowed out to you in the form of self-employment income after expenses. And so once you get to a certain threshold where maybe the business is making more than you need to take out on a given year, that's where your accountant, you guys should have a conversation around, does a holding company make sense? Where if, let's say, the business is making 150,000 a year and I only want to pay myself 50,000, can I keep 100,000 in the business? So then I don't need to pull that out and be taxed on it. I can save it within business entity. And that's where the corporation makes sense. And your accountant will talk to you in more detail about, do you have an operating company flowing up to a holding company? Some of the benefits of the holding company are: one, it's a separate legal entity. Two, you can have different share ownership structures on a holding company. So if you did want to involve your spouse or maybe children on that holding company, you could do that without them having any control of the operating company. You can have different classes of shares. So if you're the main business owner and you want to make all the decisions, but you want to be able to split income with your family down the road, but don't want them making decisions, then you can certainly distinguish between all of that. And again, this gets done or implemented with the accountants and the lawyers. So when you're a sole proprietor, there's not a lot you can do to save within your business because a lot of that's coming out every year. When you incorporate, you will probably save within your business. So then you may have some valuation within the business of, okay, what are the assets in there, right? And if your business is maybe manufacturing, maybe you have a lot of inventory or assets that are really worth something. If it's more of a services business, the asset really might just be you and what you bring to the business. A lot of times, though, on the valuation, if we're looking at, okay, if we want to sell the business, what would someone pay for it? And so there's so many different ways to value a business. And I will say, if you are thinking of selling, you should talk to a certified business valuator. The short form is CBV. So you could Google one in your area and just see who they are. But different industries have different multiples, and they may be multiples of yearly revenue, EBITDA. It may be, gross revenue. There's all different ways to value a business, but a business valuator would tell you what is the most used way in your industry. I'm sure we have all different industries on the call, so I don't want to get too specific today. But talking to a business valuator would tell you, okay, here's how you evaluate your business based on the revenue it's been earning. And then you can also look at the hard assets in your business versus talking about savings or equipment, or do you own the building that you're in, that kind of stuff. And so they will come in and value everything for you. The next thing to think about is how to sell it and who to sell it to. So we've seen some businesses where it's kind of been a family business all along, and the people who own it are getting older, and sometimes either they want to sell it to their children to take over the business or family members, or sometimes the children don't want to be part of it, and so the management team may look to say, can we buy it? And it could be like a management buyout, or sometimes it's just a neutral third party where the business valuator that you're working with will suggest, like, here's where you could go to find some people looking to buy within this industry. So they would give you some advice on that. When you sell that business, and you're going to want to do some tax planning for it, and how you sell it depends on what tax planning you do. So you need to know that there's sort of two different ways to structure a sale. And again, not up to you to decide what you should do. This is where your accountant should weigh in and give you some advice based on the type of business you have. But you can sell, if you're an asset heavy business, let's say you're manufacturing, you've got equipment, you've got a lot of inventory, you could sell the business for just the assets. Or you can actually sell the operating company. And this is where, let's say you have a holding company and you own the business, you own the building. Then if let's say the holding company owns the building, but the operating company owns the business, right? That's another reason why you might have a holding company, is if you do own the building, you'd want to keep that separate from the day-to-day of the business. So if you do want to sell the actual corporation of the operating company, then there's a whole different tax implications than if you were to sell the assets themselves. Um, a lot of times, and I've been seeing this a lot lately, people want to sell the operating company as a whole for a number of reasons. It can protect your employees. If you have a lot of employees in the company, you're selling the business with its employees. So therefore, if you've had longstanding employees of 20 plus years and this new company buys it but decides they want to, lay people off, then there's those employees are protected because they, within the labor laws would have to go through proper channels. If you only sell assets, you're essentially kind of just laying off all the employees and not guaranteeing them a future job. So employees may not be protected. So when I see an asset sale, it's usually when it's a business sort of headed up by one or two people with very little employees, where the managers are or the owners are doing most of the management and the day to day. The other thing is that we're kind of forced to see what's available to us in any given market. So there are some times where maybe it's not a good time to be selling businesses and people say, "Well, look, I don't really want to buy your business. I don't want to run that business, but I do need those assets to buy to incorporate into my business." And that's where maybe you only have a buyer that wants to do an asset sale and you're forced into that position. But this is where I say this is very important to be having these conversations with your accountant. Um, because you if you are doing the sale of the operating company, um, you want to do it at least 2 years before you're going to sell. When you sell an operating company or corporation, there are some capital gains exemptions that you can take advantage of, but it has qualifications to it. And I won't get into what all of those are because there's a lot. And again, this is more accounting verbiage, but essentially you want to make sure that you've transferred out, let's say, any real estate, any life insurance policies, any, excess cash savings or investment accounts into a holding company 2 years prior to the sale of the business, because to take advantage of these lifetime capital gains exemptions, meaning you don't pay as much tax on the sale of your corporation, um, a certain percentage needs to be involved in active business. And so real estate may not be, insurance policies may not be, investment accounts for the corporation may not be. Those are more considered like passive assets. And if you were to strip them out, let's say today, and 2 months from now, you want to sell your business, the government's going to say, no, 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 like you're just restructuring all this right now, to get this tax benefit, and you don't meet the qualification, because the qualification is 2 years prior to sale, it has to have a certain percentage of the business in active business operations. So just know, all you really need to take from this is that if you are thinking of selling your business in the next few years, don't wait until you have a buyer ready. Please go talk to your accountant and say, I'm thinking of this. This is the timeline. What kinds of things should we do over the next couple of years to set ourselves up from a tax efficiency perspective? Um, the other thing to think about too is, if you are a qualified small business corporation in Canada, there's certain tax benefits to that. There's lower tax rates to that. One of the rules or restrictions on that would be, you have to have so much of your income in that corporation. You have to have so much active business income, and you can't necessarily have too much passive income. This is another reason why people, if you start to accumulate savings in your day-to-day operating company, people will then look to have a holding company to move those savings out. because those savings will eventually generate some interest or maybe dividends or capital gains, investment income, and that is considered passive income. So it could throw your operating business offside. So this is another reason why accountants may suggest for you to have a holding company. What I will say is having the conversations with your accountant about this early is important, because if you're just starting out, or maybe you're a couple years into business and you're not at this point yet, but you think you may be, talking about this as you go is important. But it's not all done in one fell swoop. Your accountant might say to you this year, you know what, based on your income last year, you need to incorporate and you need to have this operating company. And then maybe as some money starts to accumulate, it might be 3 years later, the accountant might say, okay, you're starting to accumulate some income, which is going to, throw you off the certain rules of the qualified small business. So now you should open a holding company to move this over here. And then maybe a couple of years after that, it's starting to think about sale and structuring everything for sale. So don't think this all gets done at one time. These are regular conversations that you should be having with your accountant. But I just wanted for you to be aware that one, if you're looking for valuation, always get a business valuator, a CBV. There are two ways to sell. You can sell assets or the corporation itself. And I saw a question pop up quickly about asset sale versus share sale, and unfortunately, it sort of disappeared. But I will certainly address that when we get to the Q&A. And then just knowing some of the timelines, that if you want to be tax efficient, you can't do this right away. You have to give yourself 2 years at least to fully structure everything properly so that you're able to take advantage of, the best tax rates and make sure everything's structured to be tax efficient. So that sort of sums up, okay, selling your business while you're living. Heather, I'll get you to click to the next slide, which is more on the estate planning side. So this is where you've sold your operating company and you're just left with a holding company that has all the proceeds from your business, including selling your business. If you sold your business for $1 million, you may not be taking $1 million personally. The $1 million may stay in your holding company. And then you draw on it so much per year in retirement over a period of time to take advantage of graduated tax rates. So this is okay. I still have a corporation, even though I don't have an operating business. And how do I plan for what if something were to happen to me prematurely? Or what if I do live to life expectancy, but I'm never going to spend all this money and I'm going to give it to my kids or whoever my beneficiaries are? Then how do I do that tax efficiently? You may have heard the term from your accountant or other business owners, trapped surplus. And we see this a lot with business owners where they save, 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 save. Everything stays in the corporation. And so they have this big asset, but it's hard to get the money out because when it comes out is when it's taxable. And so if you wait too long, like you wait till you're in your 80s and you're trying to get this out, you're in really, really high tax brackets. And so trying to sort of get that money out of the corporation in a tax efficient way over a large number of years throughout retirement can help you can help your annual tax planning, but it can also minimize some of the estate taxes that might be there. So there's a couple different strategies, and I want you to know the names of the strategies, but you don't need to know how everything works from a tax perspective. Again, not your job. Your job is to focus on the business and have a good accountant in place and professionals in place to give you the right advice. But just, I want you to know that they exist. So these strategies you can talk about. A lot of families will utilize a strategy, and you may have heard of the name. It's called estate freeze. And what that is, and it doesn't just have to be done, like you don't have to use your business for this. Like I've seen people do an estate freeze with a family cottage, for example. So it can be any asset, but I'm talking about it today as it pertains to your business or your holding company. And so if you know that it is those assets are going to transfer to the next generation, you may choose to freeze the value of that at some point in your life. And I mean, talking with your accountant, you could determine when that is. I typically see people doing that, I would say, sort of mid to late 70s into their 80s. It really depends on your family situation, and everyone's family is different, but essentially you're freezing the value to say, okay, this is the value now. So I know what my tax rate is today, and any future growth is going to be in the hands of my heirs, my children, or my beneficiaries, whoever that may be. And so then you've locked in your tax rate and know that there's not going to be any more tax on this. Any other tax is going to be generated in the next generation, who hopefully has a longer life expectancy than you. Like if it's going to your kids, then you've now done this with someone younger who has a longer time before they pass away, and therefore would need to recognize any tax. So when you do this, when you create this estate freeze, what happens is, if it's mom or dad who own this corporation and they want to pass it to the kids, they freeze the value at a certain rate. So mom and dad would say, okay, we know what our taxes associated with this are today, and we're not accruing any more after today. But the corporation can then get put into a trust, and it could be a family trust where mom and dad can still have, some control over this, but you can now add children or other beneficiaries to the family trust, so that you could pay income out of that trust to them. And then when mom and dad pass, the ownership of that trust passes to the children. So that is now, the children's asset, and they are taking on any future tax implications. So, we've seen this where, I'll use the example of maybe a cottage in Muskoka that a family has owned forever, and maybe they put 100 grand into it, and this thing is now worth 2 million. So there's a big tax consequence. A lot of times you could look at it in an estate freeze to say, well, especially if we think that value is going to keep growing, you don't necessarily want to incur any more taxes. So you use the state of freeze to say, I'm going to lock in what I know are my taxes now, and then any future tax liability moves to the next generation. So it gives more time. And again, they can do their own planning with that. With a post-mortem planning, this avoids double taxation at death. There's a bunch of strategies. One's called the pipeline strategy. I'm not going to go into the names of all these, because the accountants will help you decide what is the best application for you. But essentially, in the year of death, if you pass away, the corporation has to pay all this tax, and then it pays out to your estate, which has to pay all the taxes, and there can be this double taxation in the year of death. So having this relationship with your accountant, and having a plan before passing away, a lot of the actual work that gets done for this is after the person's passed away. The accountant will do some of this post-mortem planning, but the intent on what you want that planning to be gets talked about while you're living, right? So it's sort of like creating a plan with your accountant for what happens when I pass away, so that I am not paying too much tax and my beneficiaries are not paying too much tax, and there isn't this double taxation to the company and to me in the same year. So again, that's having those conversations ahead of time, with your accountant. Another strategy, and this is being used more and more today as people have this trapped surplus in their corporation. So let's say you have all this money saved in your holding company. Maybe you sold your operating company for $1 million years ago, and that went into your holding company. And all this money has now grown, and maybe it's few $1 million. And so now it's like, well, how do I get that out into my name in my lifetime, and then eventually pass it to the next generation? When I do financial planning with clients, I go through and I will run projections. We'll say, what's your estimated taxes owing now based on what you have now. But what does that look like in 10 years, 20 years? What does that look like at age 95? And then what is the projected taxes if you do nothing, right? And that's where we start our planning process and bring in some of these strategies. So if we say, okay, if you do nothing and this corporation keeps growing, you're drawing off it every year, but you're not really bringing the principal down. And you're going to have a $5 million asset when you die with a $2 million tax liability attached to it. What some people will do is they'll say, well, I'll have the corporation buy insurance now to pay that $2 million at my death. I don't need it now, but when I die, I know there's going to be this $2 million liability, and I will buy insurance now to cover that $2 million liability. The benefit of that is that quite often, again, depending on health and age and a couple other variables, you could possibly pay 50 cents on the dollar to buy that insurance policy. So you're not actually spending 2 million for it to eventually pay out 2 million. You could maybe spend a million or 800,000. It all depends on age and health, but you're covering a future tax liability. You're doing it with less dollars, and you're doing it with corporate dollars. So it's not like you have to pay yourself this money out as a dividend, pay the tax, and then take after tax money and pay this premium in the insurance policy. The corporation can actually pay the premium. And what it would do upon your death is it would pay to the capital dividend account, the CDA, which you might have heard from your accountant, of the corporation. That then gets paid out tax free to whoever the beneficiaries are. It is so this corporate insurance is good to cover taxes from that perspective, but it's another good way. Let's say if you have two kids and maybe one of the kids is active in the business and they're going to take over this business when you pass away, but the other child has nothing to do with it, and you say, well, I'm going to give this one child this $2 million business, but I'd like to equalize my other child. I'd like to have an insurance policy that will pay 2 million to them, so that this kid gets the business, this kid gets the insurance policy, but they're both sort of equalized through the estate. And you hear parents talk about the fairness all the time, so that's another one as well. The If you have a partner, let's say there's two partners within a business, and this can be a holdco or an operating company. But let's say that what if one of the partners passed away? You don't necessarily want their spouse or their children coming in and running that business with you. So you probably have corporate documents that talk about, okay, I would buy that person's shares out, but the corporation may not have the liquid cash to do that. That's another reason why you may choose to use an insurance policy that the corporation pays. But again, it's there if you had to buy someone out. So lots of different ways to use it. Insurance pays out completely tax-free, completely probate-free because there is a named beneficiary. So it's a good way to get money out to the next generation. The downfalls or pitfalls of insurance is that, one, you have to be insurable. So you have to be healthy. If you are not healthy, then there could be a rating on the policy, or they could shoot, the insurance companies could say, we actually don't want to insure you, and they could decline it. The other thing is that the insurance policy is not that liquid. So there is a value to it. There's a cash surrender value. You could go and get that money out, but it really doesn't meet the strategy or fulfill the purpose of the strategy if you're going and doing that. So you wouldn't really want to do that. You want this to pay out when you pass away because of the tax benefits. So you lose liquidity on that. You're putting money towards the solution, but it's also money that will never pay you out on your while you're living. It's really to pay taxes and take care of the next generation. So it has to be money you're not going to need during your lifetime. Also, the older you get, the more expensive insurance becomes. So, quite often when we look at this strategy for someone, we will run a scenario to say, okay, what is the net rate of return to you? If I do it for someone who's in their 40s or early 50s, this might be like a 20% return to them. If I do this for someone in their mid 70s, it actually might be a 5 or 6% return, and that's if they're healthy and can qualify. So that's the pitfall of insurance, is that there are some limitations to that, but it is a good strategy to consider. Accountants don't typically do this strategy, but they know about it. So they can help you plan for that. And then you work with like a wealth advisor like me. How do I actually, okay, invest the money? How do I, get an insurance policy? That's where you work with the wealth advisor, but in conjunction with your other professionals, so that, you're taking all of the taxation into account. I think what I'll do there, actually, before I open it up for questions, the other thing I'll say about estate planning for your business, and this is a common item that business owners miss, and it's more of a legal thing than an accounting thing, so accountants may not mention it. When you have a corporation, whether that's operating company, holding company, um, if you passed away prematurely, whatever it says in your will, it will eventually deal with the assets in the corporation. The problem is it brings the assets from the corporation into your will, and anything that goes through the will has to go through probate. In Ontario, probate is 1.5%. So call it, you're paying a $15,000 provincial probate fee on $1 million. I can't speak to the other provinces on here. I'm not quite sure what it does, vary province to province. But so what's suggested from a legal perspective, and again, this is where you talk to your lawyer about this, you should have a personal will, and then you should also have a secondary will. And a secondary will can deal with your business specifically. And it might have all the same intentions that your regular will has. Like it might almost be like a mirror copy, saying, okay, here's the beneficiaries, it's all the same as my personal assets, or it might be someone different. But either way, it allows the business to be dealt with separate than your personal assets, and therefore you can avoid having to pay probate on that. So if it's 15,000 per million, if you had a few $1 million within this corporation, this could be a big bill. And it's not just the money factor of it, but probate can take a long time. It's usually 6 to 12 months. I saw it go 2 years during COVID. So money can get tied up and not be able to be released until probate is done. And that's why, if you do have a corporation, please talk to your lawyer about having a secondary will to cover those assets. So I will stop there because I'm talking a lot. And I'm sure there's lots of information that's gone out and a lot of things going through your head. Please know we are going to send out follow-up articles that have a lot of this detail in it. So if you're ferociously writing down notes and thinking you might have missed points, we can certainly share all of this material. And I'm sending, I think it's 4 separate articles. One's on, preparing your business for sale. One is on tax efficiency. So all of the stuff I've talked about is in those articles, and you'll be able to read through. You can even, print those off or email it to your accountant and say, hey, I want to talk about this. They're familiar about all the strategies. So you are going to get all that information. So if you miss something, you will get it all. But I think what I'll do now is open it up for questions. Heather, I can't seem to see, I'm going to try and open up this chat so I can go through the questions.
We've got a few here that I've got them all tracked. So no worries.
Okay.
I just wanted to say, first off, thank you so much. There was so much practical information in there. I know I personally learned so much. I'm excited to dive into some of these questions as well. So We have one here from Sarah. So she says most purchasers prefer an asset sale rather than a share sale because they have an easier time getting funding for that purchase. Are
Mhm.
there any recommendations for how to navigate the negotiation around the sale format?
Well, I think having that business valuator can help set you up for success for that negotiation process. They will say, "Hey, other deals have been done this way within your industry. Here are the samples of their valuations or their multiples that they used or how these deals were closed." So they are the ones you for sure want to consult about that. But you're right. If you're a buyer, if you're purchasing it, you might just want to purchase the assets. But if you're a seller, you probably want to have a share sale. So, how do you position yourself for the sale? The business valuator will help you do that. And it also depends. And I look at the housing market right now and say, okay, well, it's kind of a buyer's market right now. But we saw this 3 years ago where people were going in without any conditions, putting these bully bids in on these houses that had a waiting period. It was crazy because it was like the sellers were just, they didn't have to worry about it. So the market can shift like that in businesses too, where is it a buyer's market or is it a seller's market? And then that, whether you're a buyer or seller, could have more leverage, right? So the business valuator and your accountant will give you some more information on that. The other thing too is when we're talking about lending, and of course I work for a bank, so there's a lot of things banks will lend on, and a lot of restrictions on what banks will lend on. Just remember, and I know this is recorded, and I technically am not working for the bank, but the bank isn't your only option for lending, right? There's BDC and there's mezzanine lenders or other companies out there. Like Scotia even has a division called like commercial banking and Roynat, and they would do lending based on not just assets, but different things within the business, right? So it could be the goodwill of the business, it could be the recurring revenue of the business. So there are different options than just assets. So knowing that and working with a business valuator should help you position that to a buyer, and hopefully they'll consider what you're negotiating.
That's great. That's really great information. Thank you so much. So we had just kind of some commentary as well from Joanne here. She said that this kind of happened to her. Buyers offered to purchase assets. They listed arguments why it's beneficial for a buyer to get the entire opco. The list was quite long. She also shared that their accountant advised that we could counter, revise for a higher sale number if only the assets were purchased rather than the shares of the opco. So that in the end, the after-tax dollars we would pocket would be the same. So that was just some kind of lived experience from Joanne here as well.
Yeah, and the other thing there is it's not always about money, right? So when I talked about like protection for your employees. Like if it's just you and maybe one other person and you guys have said like, "Hey, we're selling and we're retiring and we're walking away," no problem. But
Mhm.
if you're walking away from a company with 100 employees and there's this negotiation on the table, and these are people who have become your family over the last 20 years, you may want to fight harder for this, for how you structure the sale to increase the protection for your employees, right? And so that always comes up. And again, this is where I think your business valuator would help you write a case for that. And if you want to, everything's negotiable. So if you want to lower your price to get it done the way you want it to get done, you can do that, right? Like it's just sort of a name your price, and it depends what type of market you're in.
Perfect. And we just have one kind of quick question here from Melissa, who had joined late, unfortunately. And she's just asking what an opco actually is.
Okay, so there was another question I think about the difference between a sole proprietor and a corporation. So let me kind of
Yeah,
explain all this together. So
perfect.
let's say I want to start a business today and I am, selling a certain asset, and I just start out and I say, okay, I'm going to start selling this and I just want to make a little bit. And maybe my first year I make $20,000. At this point, there's really no need for me to um, have a corporation because I'd be still be in a really low tax rate from the lower income. Um, and again, I'm not an accountant, so don't quote me on these exact numbers. But the last time I looked, you didn't even have to get an HST number until your income was over $30,000. So, when you're starting out, if your income is not high, there may be no advantages to looking at a corporation. In that case, you're filing your tax return as a sole proprietor. So you have a business, but you have not incorporated that business. You are just the business owner, you're a sole proprietor, self-employed person on your tax return, which does allow you to write things off and everything as a sole proprietor. Um, but it's not an incorporated business. Keep in mind, when you are the sole proprietor, you are liable for everything. So let's say you have a business and something goes wrong and they sue you. They're suing you as the business owner, but remember that you own that personally. You also own your house personally, your car personally, any assets for your kids personally. So you open yourself up to this liability. And that is why, as businesses start to get bigger, we look at how do we limit that liability? So we now create a corporation, because you may be at the point where you now have to pay HST on all of this and charge HST. Your income threshold may be a certain level that you want to take advantage of the small business rates. You may want to limit your personal liability. So if the business gets sued and it's incorporated, they're not coming after your personal assets for that. So your family and your home is protected. So that's sort of when you get into that stage of business where your business is making enough money to warrant this. And that's where you have those conversations with your accountant. There's certain thresholds to where it makes sense and where it doesn't make sense. So once you become incorporated for this business, this is now your operating company. You only have one company, and that's the company you're working in every day, and it's your operating company. Once you get really big in that and you start having excess savings, meaning you're not spending all the money that's coming in, your accountant may say, we create another corporation. So we keep this as just, it deals with everything to do with operations. But now there's this other corporation that owns that corporation, which is called your holding company. And that is where you keep everything else that isn't involved in the day to day of the business. So, for example, if you wanted to purchase the building that you were operating out of, you may want to have that over here because it's not in the day to day of the business. And in that case, then you can have the business rent from there. So it ends up just sort of boosting up your assets, but keeping the business operations as like this its own little silo. The other thing is if you have insurance policies. So when I talked about those strategies with insurance, you may not want those in the operating company because that may be to benefit you and your family. So you don't want that commingled with day to day operating. You want that in a holding company separate from operations. And if you start having an investment company, or sorry, not investment company, an investment portfolio, um, you that will have income off of it. And you don't want to have too much passive income in your operating company because you can go over certain thresholds that you won't qualify as a small business corporation anymore, and so you'll lose your tax benefits. That's why that sort of third step could possibly be holding company. And this doesn't all happen at the same time. You could start your business today. After year one, you talk to your accountant, they say, you know what, you're making enough money that it's justified for you to incorporate. Okay, we do that next year. That's my operating company. Maybe 10 years down the road, you've been able to save up a lot and that business has done really well. You have another conversation with the accountant. They might say, I think it's time we have this second level of corporation, your holding company, to hold all these other assets so that if you ever want to sell this business, it's clean in the operating day to day. I hope that clarifies things and makes sense, because there will be some of you on this call that will never need a hold co. And there will be some of you on this call that will never need an operating company or never need to incorporate. It really depends on the type of business, the level of income you're earning every year, the type of growth you're going to see in your business year to year. everyone's situation is unique. And this is where I say, I can give you the things to think about, but it's best for you to go to your accountant and even take some of these follow-up articles that we're going to send out and say, how does this apply to my situation? And they might be like, look, of the 10 things you brought me, 9 of them don't apply to you, but here's this one that does, and we can do something about it. So that's my hope today, is that for some of you, there might be a lot here that your accountant can do with you. For some of you, it might just be one little thing, but at least it's, giving you, arming you with some education to go to your accountant with. Um, Accountants get really busy, as we know, at tax time. And so they're not always able to be as proactive. So if you're only talking to your accountant at tax time and you're sort of giving all the documents in to get your taxes done, that's not the time you really want to be talking about planning, because they probably don't have the time to do it. So I would say, if you're getting this follow up um, information from us and you want to talk to your accountant about it, I would try and reach out maybe in the next couple months, like prior to calendar year end, and say, here's some things I want to talk about before we hit tax time, so that, I can finish this year tax efficiently, but also set myself up for the next year. And some of you may have, if you do already have a corporation, you may have a fiscal year end that is not the same as the calendar year end. That's normal. We see that a lot. So again, you have to get that advice from your accountant on the timing of everything. But I would say in the next couple of months, it would be good to reach out proactively to say, hey, I want to do some planning around this, because trying to catch them at tax time to do it is just, you may not get the results or the time that you need.
Yeah, well, we're hearing in the chat that you're getting tons of thanks for the clarity. We have some other pop-ups here from an accountant in public practice saying that they can attest to all the advice here. Very useful presentation. So reach out to CPA. So following that as well. So we have another question here from Leslie. So she says, what does one have to look at if a business is bought by a charity? So donors interested in the business being under a charity versus staying as a small business. Where can one find an expert tax accountant if the situation is complex?
That is a good question. And I have to be honest, Leslie, I don't know the answer to that. Um, Charities or not for profits have so many tax breaks that, I could talk generally about tax, but a lot of it would not apply to them. So that's a really specific question I would go to your accountant on. Now, I want to talk, you said, where can one find an expert tax accountant? So there's a difference between an accountant and a tax preparer. And your tax preparer may be an accountant, they may be registered as an accountant. But there's a lot of tax preparers out there. And I have this with some of my clients where they're like, oh, I pay my neighbor $100 to do my tax return. And that's great if you have a simple tax return, right? Like if you just have your T4 income and you make an RSP contribution every year, great. If you're self employed, if you have business expenses, if you are incorporated, even more so, it becomes complex. If you have investments, non registered investments personally or within the corporation, it becomes even more complex. Um, in the past, I used to do my own tax returns. I don't even think I could do them today. I honestly, and I definitely wouldn't want to. There are so many T slips that you'd have to figure things out with. These accountants do this day to day. Now, there are some big corporations out there, MNP, Deloitte. There's lots of firm type accountants, and they're probably, there can, you should get advice like that if you have complexity, but they can also be a lot more expensive, right? So there may be something in the middle. You could look at some smaller accounting firms within your where you live. Like I live in Burlington, Ontario, and there's a couple smaller ones here. Yes, we have an MNP office. I personally use MNP for my taxes, but there's a lot of smaller offices where you may not have to pay as much, but you are still getting that complex advice. You want to ask that question up front, like, hey, I want someone to do some planning with me on the tax side of my business. Are you the person to do that? If not, do you know someone, or is there someone within your office here who may do that? Because as your business grows, so do your needs and complexity, and you may have to move forward with a different accountant. Some accountants I found actually, and I see this a lot more lately, is a lot of them are doing like only corporations. So they will do your personal tax return if you're the owner of the corporation, but they don't do individual returns alone. They will only do it if you're associated with a corporation. And so I find with them, they tend to be more business owner focused because they are focusing and working with people who only own businesses, right? And so they're specializing in that. Again, we have people on this call from all over. So I would say, ask around within your own community, even Google it. But if you have a corporation and you have a neighbor doing your tax return for $100, you're doing yourself a disservice. You are not getting the advice you need, and the chances of error there are high. And if the government ever comes back on you for this, or there's a penalty, they're not taking any liability. You are. And at least when you're with a, reputable firm, they will back you up if there ever is an audit or anything like that.
That's great. We have two more questions that I'm hoping we can
Yeah.
try to
Yeah.
fit in
Yeah.
quickly. So we have one from Barb. She said, can you share a ballpark cost of having a business valuation done? I've heard about $20,000 to $30,000. And how often do you have to do this if you don't sell immediately?
Um, it can be very expensive. 20, 30 sounds high to me. But let's say you have a business where there's environmental factors. Like you have some warehouse that's storing something where for you to even look into what the price of your business is, you need to have someone come in to do all these environmental assessments. If you own the building that you're in, there may be a bunch of different valuations on the building because it's a commercial building. So, depending on the complexity, it can get very expensive. Um, Otherwise, I think you could probably get it done for somewhere in around 5 grand to say, hey, I just want to get an idea of what this looks like. But my guess is that if you want them to get in and start helping you position yourself for sale, finding a buyer, helping you negotiate. There's services for that too, where they'll say, we'll actually find you a buyer. We will set all this up. And of course, then there's a cost to that. So it's sort of, it probably starts in around this like 5,000 or few $1,000 mark. But if you want them to do some of the work along the way, find you a buyer, or if there's anything complex about your business where there's other, environmental or government assessments that need to be done, of course it does all add up. I wouldn't say this is something you want to do every 5 years, but I would say if you know you're probably going to sell in the next 5 years, I would approach a business valuator now to say, look, I want to start talking to my accountant about some of this tax planning. Um, and I know I need to do it 2 years before selling. When should I involve you? Right. And they might say, get everything figured out with your accountant. And then when you have your plan in place, you have your timeline in place, then we'll come in and do all this valuation for you. Or they might say, we could start with sort of an initial estimate and then continue on building on that once you're more serious and actually looking for a buyer, right? So you maybe do a little bit up front and then you add on to it when you're closer to the actual sale. So in all these companies work differently too, and their service offerings a bit different. I phone around. I always say whenever you're phoning an accountant or any service provider, you should probably phone 3, find out what they do, find out their pricing, how they work, and just see who you feel comfortable with too.
Mhm. So one last question. I don't know
Yeah.
if we'll have full time for this one because it might be a little bit more
Yeah.
complicated, but Kathleen said, can you share, can a share sale be done in exchange for labor? So the person exchanges ownership shares in exchange for labor from the buyer, an example being labor such as personal care.
Whew, that is a good question. And I will say again, I don't know the answer. An accountant would know, but I do know that there are different ways to structure a share sale. So Especially when it's family or management buyout, where there may not, if you had a neutral third party coming in, they might just say, "Hey, I have this money, or I was able to qualify for this loan. Here's the money." A lot of times, when it's someone buying it, they want to buy it over a longer period of time, and there's that trust there that you can do that. And they may do things like a vendor take back, or there's a portion held to say, "This revenue will come from the company over the next 5 years." Could you do that and say, "Okay, we're sort of paying off a portion of this with labor?" I think you might, but I would definitely run that question by an accountant as to how that would get papered and how CRA would look at that, because you want to be careful that this is all on side with the Canada Revenue Agency.
Absolutely. Okay, well, we are at time here, so I want to be mindful of everyone's very busy schedules, but I want to thank you, Jill, so much for all of the information that you shared today. It sounds like everyone here today has picked up so much information for this presentation, so valuable. So I want to thank you so much. And as a reminder, we have recorded this, so either this afternoon or tomorrow morning, everyone will receive a link to be able to replay this or share with your network, along with some really great resource links that Jill has curated for us. So just want a quick update from the Strike Up side that Strike Up Connects will actually be pausing. This is our last one for 2025 as we prepare for Strike Up 2026, our national digital conference for women entrepreneurs, which is co-presented by Scotiabank Women Initiative. So everyone mark your calendars for Thursday, February 26th, 2026, and watch for registration details on our site. We do open registration December 1st, and a little insider tip for those here today, it could be worth your while to be amongst one of the first to sign up. So there will be more details to come with that. I want to thank you so much again, Jill, for sharing and for everyone spending their time with us today and your incredible questions. Thank you so much, and I hope everyone has a great afternoon.